Hi, everyone. I'm Ann Sonders, and this is the August Market Snapshot. Happy summer to all of you. Well, we're more than halfway through 2026, and while headline index returns look pretty solid on the surface, the S&P is up 13%, Nasdaq up 14%, Russell 2000 of small cap stocks up 23% all year to date. But what's happening beneath those numbers tells a much more complex story. So today, let's explore the divergence between index performance and actual market participation, what that means for investors, and where we're seeing real strength. So let's start with the elephant in the room, drawdowns. Now, while the S&P 500 has seen a maximum intra-year drawdown of only about 9%, the average member within that index has experienced a 24% drawdown from their year to date highs. That's a meaningful disparity. The NASDAQ tells a similar tale. The index is up 14%, but individual members on average have had a 42% drawdown from their highs. And this divergence is significant because it reflects a market that is seeing a tremendous amount of leadership rotations and churn under the surface. Now, when we look at market breadth indicators, specifically the percentage of S&P 500 members trading above their 200-day moving average, we see something quite telling. As of mid-August 2026, 72% of S&P 500 members are trading above that key technical level, while it's 68% for the Russell 2000. The Nasdaq has actually been the laggard, sitting at 49%. Now, for context, this isn't necessarily bearish in absolute terms, but what it indicates is that we're not in a broad, all boats rising at the same time kind of move higher. Now, at the sector level, the strongest breadth has been among the energy, financials, and healthcare sectors. And bringing up the rear are utilities. When we look at the percentage of members above the 50-day moving average, what we might call intermediate term momentum, we see that about two-thirds of the S&P sit above that level. That's a reasonable number, and it suggests the intermediate trend is intact. But the disconnect between index performance and individual stock participation means that profit taking has been selective and benefits have still been somewhat concentrated, albeit rotational. Now, as many viewers know, we publish at Schwab sector views, and the sectors right now on which we currently have favorable ratings are financials, healthcare, industrials, and materials. On the other end of the spectrum, the real estate and consumer discretionary sectors are our least favored. For more, by the way, on our sector views, check out our monthly stock sector outlook under the Learn tab on schwab.com. Moving on, when we measure what percentage of S&P 500 members are actually outperforming the index itself, the numbers become a bit more striking. So over the past month, about 45% of S&P 500 members are outperforming the index itself. However, you can see in the chart that it wasn't long ago that that was more than 65%, much broader participation relative to the anemic 13% over the past year. In other words, there has been a recent slight fade in the percentage of stocks outperforming the index itself over the trailing 1 month period. And that does provide a little bit of a dent in what had been a pretty powerful broadening narrative. And the sector data reinforces this narrative. Energy stocks show 24% of members making 4 week highs, 14% making 52-week highs. That's relatively strong participation. Financials show similar strength. But notice real estate and consumer staples, each with 0% of members at 4 week new highs or 52-week new highs. Even within technology, only 19% of members are making 4 week highs, despite the index's outsized gains. That tells you that concentration is still a force in the markets. It's just been amid rotation. Let's move now to the individual stock level to some degree. Earlier this year, I added two stocks to what has long been the popular Mag 7 grouping, and I've been calling it the Neural 9. And it includes star performer Micron as well as Broadcom, added to the original Mag 7. Now, among that group of nine, Micron leads with a year-to-date gain of nearly 220%. The next best performers among the group are Broadcom and NVIDIA, each up a much lesser 20%. But here's where the divergence really crystallizes. Beyond the semiconductor universe, performance deteriorates substantially. Microsoft is barely up, all the way down to Meta and Tesla, each with double digit year to date losses. One of the morals of this story is that you can't look at groups of stocks as monoliths necessarily anymore. I also want to point out the differential between the S&P 500's performance and contribution ranks columns. So in the case of the latter, let's look at the contribution ranks. Contribution rank takes into consideration not just price performance, but the market capitalization of each company. So you're multiplying them together, price, performance, and size, and that gives you the contribution. And an example of how these can diverge might be NVIDIA, which is the number 2 ranked stock in terms of contribution to S&P 500 returns this year, but its performance rank is 160th. Again, the differential being a function of the massive size of NVIDIA. Now, at the bottom of the list are Meta and Tesla, with their weak price performance combined with their large cap sizes, putting them dead last from a contribution standpoint. Here's what I'd emphasize as we look forward. Strong index returns can mask internal churn, which we have been seeing. The fact that 87% of financials, 83% of healthcare, 81% of energy stocks are above their 200-day moving averages compared to just 72% for the S&P 500 overall, that suggests that the underlying strength might be found outside just the mega cap technology space. For investors, all this wraps together and represents a critical moment for rebalancing discipline and diversification across the equity asset class, specifically at the sector level. The market's message is becoming increasingly clear. You cannot assume that broad index exposure alone is capturing market opportunity. Winners and losers are diverging more sharply, and we believe the divergence may be a bit structural, not only cyclical. That's been the real story so far in 2026, and there'll be lots more on that to come. Thanks as always for tuning in, and I'll be back next month.